Hi, everybody. I'm Jeff Mayers from WizPolitics.com. Welcome to our virtual event today. It's part of our DC event series, and I want to thank our sponsors and partners. Michael Best Strategies, WPS, Health Solutions, Excel Energy, and Exact Sciences. Those are our sponsors, and our partners are UW-Madison and the Wisconsin Alumni Association. Thanks very much, sponsors and partners, and thanks to all of you for tuning in today. If you have a question and you haven't submitted it in advance, and you're on the webinar, you can go to the webinar and submit a question on the chat function, and we'll try to work those in at the appropriate time. So today's program is gauging the federal response, the economic response to the pandemic. I mean, we're in uncharted territory here, and so we thought it would be a good idea several months into this crisis to check in with some smart people who follow the economy, follow the Federal Reserve, and follow Congress. First up, we have Thomas Wallstrom. He's a senior business economist with the Federal Reserve Bank of Chicago, and he's going to provide a briefing for us on the state of the national and Midwest economy. Welcome, Thomas.
Thanks.
How are you today?
I'm doing well.
Great. Beaming in from your children's playroom there.
Yeah. Oh, yeah. If people really want to see, I can turn to the side. You can see my Hot Wheels track behind me. It's what I do when I'm not thinking about the economy.
Okay.
Play Hot Wheels.
Well, give us a snapshot of what's going on in your view of the national economy right now.
Sure. Yeah. So actually, before I get into where we are at this moment, I thought it'd be useful for me to give you a brief run through of a macro 101 framework for understanding the COVID-19 pandemic and how it's affected how it's affected the economy. So let me briefly touch on that. So this is the way I've been thinking of it as we've been going through this. So, maybe you're familiar with the kind of the two main concepts that hopefully everyone's heard of, who, even if you haven't taken an economics class, and that's supply and demand. So when we think about this in terms of the macro economy, we think of the supply side, we think of a supply side and a demand side, and it's kind of like the sum total for everything going on in the economy. And so the supply side summarizes the economy's capability of producing goods and services. So it's just what is the total amount that we can produce? Sometimes it's called potential GDP. And that's going to be a function of technology, a function of how many people are in the country and their education level, and then the quality of a country's institutions. Those all determine how much a country is capable of producing in terms of goods and services. So then there's the demand. So that's the supply side. Then there's the demand side. The demand side summarizes people's willingness to consume what the economy can produce. And so, as I think about this recession, it's been declared a recession already. Usually it takes longer than this. But most recessions that we see are typically driven by the demand side. It's not solely the demand side, but that's typically the big that's the bigger side of it. And there's some disagreement on the details, but if you think about the Great Recession, that's generally viewed as a negative demand shock that was caused by people, waking up and realizing that their houses weren't worth what they thought they were because of the housing bubble, and then they cut back on spending because of a understanding that they had less wealth than they thought they did. And then there was also a financial crisis, in the financial system that forced businesses to cut back on spending. But both of those are demand side. On this shock is different, or this recession is different in many ways. It's in some ways it's very easy to think of it as a supply shock, but it's also a demand shock at the same time. So it's less clear which is more. I think there's both going on, but then it's a question of which one is stronger, at least from a macro 101 perspective. So the way I think of this is like, think of a restaurant. On the supply side, it's just how much how much food is a restaurant capable of selling. And what we've seen is that restaurants have had to cut back on their capacity quite a bit, cut back on their supply quite a bit. They have to either be completely shut down in some cases, or they've had to very much lower their capacity in order to keep their workers and customers safe. So we've seen a pullback in the supply side, very much so in like the leisure and hospitality sectors. But then on the demand side, we've also seen that people are very reluctant to go to restaurants. So it's happening on both the supply side and the demand side. What the COVID-19 is affecting, pandemic is affecting both sides. And so an academic question is kind of which. It's not just academic, but this is where the academic questions would start. Is which is going on, which is a stronger shock. So if the shock is more on the supply side, as I think of it, we should see big lines at restaurants, people trying to get in, and the restaurants just can't serve enough people because of the supply constraints. And, then you'd expect to see them raising prices to ration demand. If the shock was more on the demand side, we should see empty restaurants, even though they're open and running at limited capacity, and we should see restaurants lowering prices to get people to come in. So that's a restaurant example. At the macro level, rather than the price of food at a restaurant, you talk about inflation. So we should see increasing inflation if it's more of a supply shock, and we should see decreasing inflation if this is more of a demand shock. And what we're seeing is actually we're seeing inflation is decreasing. So it seems like it's more a demand shock that's bigger than the supply shock, even though they're both clearly going on in a way that's different than what we've seen before. One thing, especially in regard to think about in regards to the actions of the federal government, particularly Congress, is that the weird thing about the stimulus that Congress did in terms of raising UI benefits, sending every household cash, and the Paycheck Protection Program, which were all cash grants to businesses and households. People have been getting a lot of cash up front, but they're not going to restaurants and other leisure and hospitality businesses to spend it, presumably because they don't feel very safe, or they're maybe some are still shuttered. But what it means is that people are sitting on this stimulus money that's supposed to be increasing demand. They're not spending it. They're either sitting on it maybe for insurance purposes because they're not sure what's going to happen going forward, or in some cases it's just not easy to spend it. In certain circumstances, it's harder to, if you're really playing it safe, going to the store, it takes more time and more effort to go spend money.
Well, that would make me worry about deflation.
Yeah, so I think if you look at what the FOMC is forecasting, they're not forecasting deflation, they're forecasting disinflation. They're forecasting inflation to be, I think, somewhere between about 1% and 1.5%, which is actually, we've had inflation. That's been one of the things the Fed was struggling with before the COVID-19 recession hit. Was we were struggling with trying to get inflation to go up to our target. I think there also are some cases where you might see, we have seen prices go up in response to the supply chain problems, like for food and certain, toilet paper, of course, and things like that. But I think the overall expectation is not deflation, but just low inflation going forward.
So what can you tell us about the Midwest economy in terms of how it compares to the national economy? Is it reflecting the same weaknesses?
Yeah, so actually, let me say I actually had a couple more things to
Oh,
say
I'm
about the
sorry.
in
Go ahead,
terms of,
finish up.
but this is important because and I'll bring up one of my points I was going to make about Wisconsin and the Midwest up to now, which is, Wisconsin and the Midwest generally share fully in a recession. There's never been a case where, the Midwest and Wisconsin are in recession and the country isn't, or the country's in recession and the Midwest and Wisconsin aren't in a recession. So, some states like, say, South Dakota during the shale oil boom, that happened a little bit later than the Great Recession, but some states actually didn't really see much in terms of the Great Recession. We haven't seen that for any state. We've seen some variation, but this is really not a regional shock or even a national shock. This is truly a global economic recession. That's, it's, everywhere's shut down and maybe starting to open up, but everywhere's been hit by this. Um, and so what I was going to say in terms of the national situation, that's really important in terms of thinking about the Midwest and Wisconsin, simply because what's happening at the national level is going to be the first part of the story that you'd want to tell about what's happening more locally. And so what's another strange thing about this recession is that it's extra difficult to track the economy right now because things are moving so quickly. uh, we used to rely on monthly, and it seemed like month data coming out on a monthly basis was pretty frequent, and GDP comes out on a quarterly basis. But the changes happen so quickly with this pandemic that the monthly and quarterly data get stale quite quickly. So one of the things that I would point everyone toward is, I think, a good way to keep track of what's going on at a higher frequency is the New York Fed has this weekly economic index that they've created recently. It takes 10 data points that come out on a weekly basis and summarizes them as one number. It's benchmarked to GDP, so it's pretty straightforward to understand. And they actually just had a release at 10:30 this morning, and it's showing that well, the first thing it shows is that this recession is the drop in activity is way deeper than the Great Recession. It's way faster and way deeper. Um, but it's already come back after started to come back after a couple months of a huge drop. So national activity bottomed out in about the middle of April. It's been steadily moving up until this last week. So this last week, the index ticked down a little bit, still higher than where we were in the middle of April, but it ticked down. And of course, that's not surprising given the news that we've been seeing about many states pausing or reversing their reopenings in response to the very high numbers of new COVID cases. And I think, and then thinking in terms about the national moment a little bit more, the big question is how much is the second wave of cases, if you want to call it a second wave? Maybe that's not epidemiologically correct to call it a second wave because maybe the first wave never finished. But if we want to call it the second wave, when if question is excuse me, that we're seeing this slow recovery. Is this second wave going to push economic activity? Is it going to slow it, or are we actually going to see things come down? It looks like it ticked down a little bit for this last weekly reading. Is that just a blip, or is it going to further tick down as the kind of second wave continues? And of course, no one knows. I don't think what's going to happen here, how big the wave is going to be, and what the economic impacts are going to be. How deep or slow it's going to be to recover. But I think that this current situation, this current very recent situation with the big increase in cases coming forward, has made, many have made this point, and including Chairman Powell, that the virus and our success in containing it are going to be what determines how quickly the economy recovers. And so now I can turn to the Midwest and Wisconsin a little bit more, having made those points. I have spent some time looking at the state level data. That's kind of my job as someone who tracks regionally the Midwest. And, the state level employment data do show some variation across states. So, every state has seen a historic drop in employment and economic activity in the last 4 months. But some have seen it worse than others. And, there are there's one major thing that's driving the differences as far as I can tell. And it's not going to be surprising to hear this. It's the size of the outbreak. So there's a clear negative correlation between, this is one thing I've looked at, the cumulative number of COVID-19 deaths per capita and the size of the drop in employment. States that have more deaths per capita have saw a bigger drop in employment so far. Again, employment's dropped everywhere, but it's the harder hit states that have suffered more. And, so I think we're seeing at the state level too, that containing the virus really is the key to being able to resume economic activity to get back to where we were. There are also, for someone whose job it is to kind of tell stories about what's going on at a regional level, the standard thing that we do is we talk about industry mix. So, some states are concentrated in manufacturing, like Wisconsin. Some states are concentrated in high tech like California. So that's usually the story that we were, industry mix stories are usually the ones we talk about in terms of what's going on at a region and during a recession. Um, and so it's there is some industry mix story. The big one is leisure and hospitality. That's the sector, the industry that's really been hit the hardest, way more than other sectors. We saw 40% drops in employment nationwide or so, and even more in some states. The thing is that leisure and hospitality is relatively spread out across the country, except for some, yeah, at least at the state level, except for some notable places like Hawaii and Nevada. So those places, even given their initial outbreak, we saw a big drop in employment that was outsized given the size of at least their initial outbreak. The other story I would tell in terms of Wisconsin is, Wisconsin really is a manufacturing state. It's one of the most concentrated in manufacturing in the country, and it does durable goods manufacturing on top of that, which tends to be hit hard during recessions because businesses and households pull back on investment. And that's still happening, even though that's not the main story. I think what that, Wisconsin being a manufacturing state and manufacturing actually being able to um, manufacturing being able to kind of solve the COVID challenges in terms of capacity um, pretty easily compared to say hotels and restaurants. It's still likely, I think, to be held back until the rest of the economy recovers, simply because of lack of demand.
Okay, so you mentioned hospitality and leisure, obviously, as worrisome sectors that hit the hardest, and manufacturing, durable goods. In a recession, any recession, that's bad. What
Yeah.
are there other warning signs about other sectors? The real estate market seems to be still perking along, which that says something
Yeah.
about confidence in the economy.
Yeah. I mean, I think, I think I guess I already mentioned, the ones that I think the most worrisome one for sure is the leisure and hospitality sector. I mean, it's, um, you know, there's just, from what I can tell, they just don't have an easy way to keep their workers and customers safe, as opposed to manufacturing, as opposed to like real estate, where you can make adjustments so that people can feel safe viewing houses and buying and selling houses. You know, we've seen leisure and hospitality really get hit hard already, and it just seems like it's going to be hard for it to come back in any strong way. And maybe some really creative people that are more creative than can figure out a way to operate at a higher capacity, figure out a way for restaurants to operate at higher capacities. Maybe it's possible before there's a vaccine or an effective treatment, or you know widespread cheap and easy testing. But it seems like an extremely difficult puzzle to solve. And I think because of that, I think it is going to weigh on the demand side for pretty much all the other sectors. They're not going to be hit as hard as leisure and hospitality. We might not see as many business closings as we keep hearing about. There were a number of stories in the news just today, about places that have decided to permanently close just because restaurants and the like, because of how challenging it is to stay open and make a profit when you have to be worried about shutting down again, or operate at a really low capacity. But yeah, I mean, but for Wisconsin, which again is a manufacturing state, it's got a sizable leisure hospitality sector too that's going to be hurt. And all the other sectors, I think they're going to again not be hurt as badly perhaps, but they're still going to be, I think, struggling until we're able to largely put the virus behind us. And I think there's just at least for me, and it seems like for pretty much everyone else, there's a huge amount of uncertainty about the timing of when that's going to get resolved.
I think it sounds like it all adds up to a slow recovery. We're past the talk of a V-shaped recovery, right?
Yeah, I think I keep hearing talking about the a swoosh recovery, and that's, if you look at this, well, it's kind of depends on how you look at, say, the New York Fed's weekly economic index, it's so far the recovery has been sharper than the Great Recession. It was also the fall was much sharper, but I think it's I think when this was first starting, maybe we were all expecting that we might have be able to get back to normal by the end of the year. And one part of my job is to survey business leaders throughout the Midwest and ask them what they think. And many of them think I think most or more than 50% in my last survey thought it would be past the end of 2021 before we'd get back GDP back to where it was before this started. And that's that lines up pretty well with what the the Fed forecasters themselves across the Federal Reserve System seem to think too. They think we're going to get about they're forecasting around a 6% drop for GDP for the year on net, and then a 5% growth in 2021, which means that they're not expecting us to be back to where we were until maybe the first half of 2022.
Okay, so the Fed, has done some unprecedented things, and Congress acted very quickly. I mean, the federal response has been huge in terms of the number of dollars sort of washing through the system, right? But some of these are going to expire soon, and you talked about people kind of sitting on their money. So, what do you think policymakers can or should do? What would be the best course of action to do now to sort of speed things along?
Right. Yeah. So I mean, I think that the thing I would emphasize is that this first is that this is a health an economic crisis caused by a health crisis, and figuring out how to control and contain the virus should be is, I think, and should be at the top of the list for how we can get an economic recovery to take hold in a really strong way. But then, yeah, the question for the Fed and Congress is there anything more that they can do? So, the Fed, um, we acted quickly, and a lot of our work was to provide liquidity to the financial markets, which is something that in the Great Recession was something that we worked. It was a big problem, and I think we learned from that, and we acted swiftly. And I think in general, folks seem to think that the actions were warranted and worked out pretty well in terms of helping the financial markets to keep functioning. We also lowered interest rates, and our focus really has been on trying to keep the cost of borrowing down. And I think we'll keep continuing that. There are some things that we, of course, will keep maintaining our the interest rate is that we have control over as low at zero, the short run interest rate for a while. And then, there's some talk of the Fed trying to do more to control long-term interest rates. I'm not, that's a discussion that's ongoing, and I don't have much insight into how likely that's going to going to happen, that the Fed's going to really ramp up some its efforts to lower long-term interest rates more. And so at least on the Fed side, it's really about lowering borrowing costs. And on Congress's side, it's more about, as we've said, getting people cash in various ways, getting households and businesses cash. And, so in terms of getting more cash, there's, as a general rule, folks at the Fed, we don't talk about what Congress should do. That's Congress's job to figure it out. But what I can say is that Chair Powell and other FOMC members, including Charlie, our president at the Chicago Fed, they have expressed the view that they think that more fiscal support for the economy from Congress is likely to be needed. And so with that, that's what I can say about the Fed's and Congress's response so far.
Okay. Well, do you have anything to add before we move on to the rest of the program?
No, I think I've answered everything as to the best of my ability.
Thomas Wallstrom, thanks very much from the Chicago Fed. Thanks very much for joining us today, and please keep in touch.
Yeah, thanks for having me.
Okay, now we're moving on to a panel of DC journalists who will help us dissect what's next for the Fed and Congress. So I want to welcome in our three DC reporters. Victoria Guida is a Politico financial services reporter covering banking regulations and monetary policy. Welcome, Victoria. Torian Small is a Washington correspondent with the Spectrum News DC Bureau. He covers the Wisconsin congressional delegation. Welcome, Torian. And we need to bring in Polo. We'll be calling in Polo real soon here. David, can you help bring in Polo? There he is, Polo Roca. He's a reporter with S&P Global Market Intelligence News Service based in DC. He writes primarily about the Federal Reserve, and he's a former WisPolitics.com reporter, so he's an all-around good guy. So, okay, welcome panel. Victoria, I want to start with you. What did you hear from our economist, Thomas Wallstrom? You know, everybody's sitting on their money, I guess. That doesn't seem to be a signal to put more money into the system, or does it?
Yeah, well, so we're kind of at a I don't know if a turning point's the right way of putting it, but we're at an important moment for the economy because, you know, over the last few months, we've obviously seen this horrible shock to the economy, which, you know, Thomas was talking about extensively. But Congress did a lot of things, right? They sent checks to people. They launched the small business lending program, which, you know, seems to have been effective at protecting a fair amount of jobs. And, you know, the Fed, as he was saying, also has helped keep borrowing costs low. So a lot of larger companies have been able to, you know, keep having cash come in, even though maybe their revenue has been depleted. So, you know, government efforts so far, you know, some things have worked better than others, but have seemed to have done, you know, a decent job of making sure that this recession wasn't even worse. But a lot of that help is running out. So when you talk about people putting money into the economy, you know, if you look at the data, actually, when people receive their stimulus checks, you know, people spent that money right away, and that was actually really important for the economy. And you know, because it went primarily to people who weren't just going to, you know, either stock it away or put it in the stock market or whatever. There was people who needed it for food and other things. You know, maybe they used it on buying clothes or things like that. But the point is, we could be reaching a point very soon where a lot of that support runs out. And so we could see a big drop off in economic activity.
Polo, you primarily cover the Fed, and I'm wondering, you know, we've heard this, the Fed to the rescue. Has the Fed been there to the rescue, and are people, or governments, are businesses fully tapping into what the Fed has offered?
Yeah, so I guess, you know, just talking with economists and analysts and such, I guess maybe I'd break down things into a couple buckets. So one is on the kind of plumbing of the financial system, the kind of super boring but important stuff. In mid-March, there was a lot of pressure. Companies that, you know, usually can borrow money for, you know, payroll purposes, very short-term things. They were having trouble doing so and were being charged a lot to do so. So the Fed stepped in and, you know, set up a facility that basically said, you know, we will buy that paper at a higher rate. We will be kind of a lender of last resort, is what they call it. And so that really kind of helped reinstill a lot of confidence that really dropped in mid-March. And you know, the Fed has not actually had to lend a lot necessarily to companies, but you know, just by having that backstop and saying that we will be there in case things go bad, and things were pretty stressful at the time, right? Just having that backstop and announcing those facilities really helped calm market conditions, really helped investors kind of take you know, some risks again, or kind of do what they generally do to keep the you know, money flowing throughout the economy. You know, I'd say just corporate bond markets in general, some kind of longer term borrowing, all of that kind of stress really kind of spilled over into you know, companies that want to borrow for 10 years for a new project or whatever. And so just the Fed's kind of announcement of some of these, financial market liquidity facilities have really kind of eased borrowing conditions. And on the municipal market front, I mean, a lot of state and local governments, they borrow money short and long term too. And so investors, they were not necessarily thinking that, state and local governments were now a bad investment, but everyone was just looking for just cash. No one wanted to lend money anymore. And so things have really calmed down in the market there. I'd say when talking to analysts and such, things that are more in the incomplete bucket is some of the Fed's help toward medium-sized businesses. So all that financial market stuff really made it easier for kind of bigger companies to borrow kind of at short and longer term, durations and just kind of keep afloat, right? And then on the kind of small business side, the Paycheck Protection Program that Congress launched, that's helped companies with less than 500 employees and, kind of helped sustain payrolls and whatnot. But there's a whole kind of like section of companies in the middle, a company that has 1,000 employees and such. There's certainly banks are willing to lend right now, and banks, interest rates are cheap, and companies can borrow from banks as they'd like to. But the Fed has launched a Main Street lending facility to kind of lend to those medium-sized companies as well, and that really kicked off in full last week. Hasn't really been too much interest in the early days, but certainly could take up. So that's kind of one thing where the middle market type companies are, that's something that is incomplete, but certainly they can borrow from banks in many cases right now.
All right. Before we get to Tori and Victoria, a point of clarification, something that Polo mentioned. Can a state and or local government use a Fed program to borrow to fill their budget deficit, for example?
So the answer is it depends. The Fed does have a program that's specifically dedicated to state and local governments. It's open to all states and a fair number of cities. But there is a sort of population threshold, so a lot of small cities can't directly borrow. They can borrow through their state. But a lot of states have restrictions. They have balanced budget amendments and things like that make it difficult for them to borrow through this Fed program. So yes, in theory they can, but the question is whether their restrictions and their current financial realities make the Fed program make sense for them.
Okay. All right, now we're going to move to Congress with Torian Small from Spectrum News. Torian, welcome. And you cover the Wisconsin congressional delegation. How do the Wisconsin Congress folk, what do they think about what Congress has done so far and how it's working?
Well, I think we're in the moment of introspection for a lot in our delegation, specifically Senator Ron Johnson. I asked him about the next plan, the next phase, whether or not Senate Republicans would be on board to adopt some of the policies in the HEROES Act that the House passed back in March. And he said he would rather take a look, a fine-tooth comb really through the CARES Act to look at some wasteful ways that Congress spent federal money in the effort of just being reactionary to what we saw happen, the pandemic. So he's not really looking forward to talking extensively or even being on board for passing another phase in federal relief until we really take a examination at how it's been spent, what the impact has been so far. But Senator Tammy Baldwin is obviously in lockstep with Democrats who say urgency is key here, and we need to move forward with the HEROES Act or something similar sooner than later, because there are still people who are out of a job right now looking for federal relief, the next wave of federal relief. And she's really pushing her colleagues on the right to move the needle. In the House, again, as we saw back in March, they passed the HEROES Act. It's worth about $3 trillion. It would include another round of individual checks. But again, this is a divided Congress, so nothing is ever really easy. I think the most collaboration that we saw happen at the earlier part of this pandemic, as we're several months into it now, this is where we start to see those divisions.
Yeah. So, I mean, if you had to speculate, the stuff that's expiring, the $600 a week checks, the unemployment bonus, more checks, more direct stimulus checks. I mean, do those things have any chance in the Republican Senate?
So it doesn't seem likely, only because there isn't a exact consensus among Republicans yet. Now, Mitch McConnell is looking into, Senate Majority Leader Mitch McConnell is looking at that. But even when it comes to the next round of individual checks, he's really favoring a cap of $40,000 or less for the next round of aid, because he believes that's where the true need is. And he believes that that's largely the hospitality industry. President Trump said that he's more than willing to accept another round of individual checks, especially as we get closer to election. It would only be favorable for his administration. But Republicans aren't really that united on what to do next, especially as it relates to some of the policies that Democrats put in that HEROES Act. So individual checks is still up in the air at this point. Extending the unemployment benefits, still up in the air at this point. Just looking at some other Republicans in our delegation, Congressman Glenn Grothman has been pretty adamant against extending unemployment because he believes it breeds a sense of laziness. Who would want to go back to work? This is being his words. Who would want to go back to work if they're getting more money through these unemployment benefits? So it's really hard to tell at this point.
Now, Congress is back later this month, right?
Yeah, so the Senate returns July 20th, I believe, but they are really working with a small calendar here. August is historically when Congress takes an extended recess. So not including that month, if nothing gets done by the end of this month, it'll be a while before we even before they consider another wide sweeping stimulus bill.
You don't sound that hopeful that something's going to happen by the August recess. Am I reading you right there, George?
I think the biggest thing is whether or not both sides are willing to go back to the negotiating table. Democrats are pretty dug in on their HEROES Act. So if they're unwilling to move on that, it'll be really hard to push Republicans to come to some consensus before the end of the month. But Senate Majority Leader Mitch McConnell did say he's eyeing the end of the month for some type of action. So we'll see. It's the best I can give you right now.
Yeah, but this early consensus, as you said, has pretty much dissipated. We're back into sort of partisan politics. Okay, now, so if Congress doesn't act, let's just, this is somewhat speculative. I'm going to go back to Victoria and Polo here. But if Congress doesn't act, let's start with you, Victoria. That would seem to put more pressure on the Fed to do more or to ramp things up. Do you see that happening? Because they can do that maybe unilaterally in concert with Treasury?
Yes. So the caveat there is the Fed chair, Jay Powell, he says all the time that the Fed has lending powers and not spending powers. And so you're absolutely right that if Congress doesn't do more, the Fed will kind of be, as they say, the only game in town. And, you might see more pickup. I think Polo mentioned that the Fed has a mid-sized business lending program that's for companies that are sort of too big for PPP, but not big enough to borrow through bond markets. So you might see more ramp up in take up there if people don't have other options. But the problem is, again, the Fed is facilitating debt, and at a certain point, more debt only helps so much if you're not having income, if you're not having revenue. And so that's why the health response is so important here, because, I mentioned earlier that a lot of the economic policies that Congress and the Fed have pursued seem to have helped. And now the question is whether, we've kind of squandered some of that because there's still so much work left to do on the virus where we still haven't kind of gotten it under control. And so, yes, we are increasingly facing a lot of bad options if businesses can't go back to normal, right? Because it's very hard to supplement actual revenue, actual income with debt. And we maybe have a period of time where that's still going to be sustainable, where businesses can keep borrowing just to get to the other side. But there's at a certain point, you basically either need businesses to be operating again or Congress to do more, or more likely it will probably be some combination of both. I imagine Congress will do something. The question is just kind of the scale of it.
Polo, what's your view of this in terms of if Congress doesn't act by the August recess, then does the Fed say, okay, I guess we got to ramp things up?
Yeah, I think I'd agree with Victoria. Is there's certainly more that the Fed can do. They have a bunch of programs like the mid-sized business program. They could tweak things and make it more attractive. They could make it cheaper for companies to borrow. They could let smaller kind of companies borrow through that program. I think they have they've proposed to expand it to nonprofits, and so they could get that rolling and get that going, which I think folks expect them to do. And on the municipal front, I mean, they can make it cheaper for state and local governments to borrow from the Fed. Right now, it's really only expected to hit state and local governments that maybe are at bigger credit risk to investors. So only Illinois has borrowed from it so far. And so, it could tweak some of its programs and expand them. And there's still a lot of money left over that the Treasury can basically use to invest in all these Fed programs. But like Victoria said, I mean, Fed chairman talks about this all the time, is the stuff that the Fed launches, they're lending programs, not spending programs. And they, expect to get money back. I mean, obviously with any lending, there might be like limited losses, but, what the Fed cannot really do grants and is very limited in how much it can do. But so, I think a lot of probably a lot of investors are probably expecting some sort of relief package. Kind of the details aren't clear, but like I said, the businesses, state and local governments, certainly low cost loans help, but you need actual cash at the end of the day sometimes, and you might not want to saddle yourself with debt. So if you look at the municipal bond market, where investors lend to state and local governments and transit authorities and such, things have really calmed down there, partly because of the Fed's kind of willingness to be a backstop there. But analysts kind of talk about the fact that investors also expect some sort of fiscal relief to happen from Congress, and some of the calming in municipal bond markets that make it easier for state and local governments to borrow. Some of that is partly because investors expect more fiscal help. So I think to a certain extent, I think the Fed can certainly do more, but ultimately I think there's just widespread agreement for that. Congress could play a bigger role too.
Okay, Torian, let me go to you on this. This discussion of helping state and local governments, that's really fallen along party lines, it seems. When the debate was in the House, certainly, that got rolled into what the House passed. But that seemed to be, can you capsulize the discussion as to why Republicans oppose, a lot of cash infusion for state and local governments to help with their services?
Well, I think we saw this debate during the initial start of this discussion, just because some Democrat states, according to Senate Republicans, are seeing, debts and deficits before this pandemic happened. So their mindset is, why should we bail out these states where Democrats have control? But again, this is a pandemic that has impacted everyone. So Democrats' rebuttal to that is it would be irresponsible to pick and choose where this aid goes. That's why we saw in the HEROES Act that passed in May, I think I said March initially, it passed in May. It was wide sweeping. So it's for state, it's for, local, but then also tribes and municipalities as well, to be all inclusive instead of focusing on these individual things. Democrats' idea at at this point is it's too early to tell when this will be over or who will be impacted more by this or not. So they would rather take a blanket approach like Congress did with the CARES Act instead of a more targeted approach, because one, that would take too long. And again, urgency is the biggest thing for them. But also they think it's better to be inclusive as we're talking about a pandemic that doesn't happen very often. So with a historic amount of spending, they would rather protect everyone than taking a fine-tooth comb to this issue.
So you can't help but think that this is an election year, right? So for Congress, it seems inconceivable to, it seems conceivable to me that Congress could fail to act before the August recess. It seems inconceivable to me that they wouldn't do something in the fall before they're up for re-election. Am I being too cynical?
I think you're being a realist, because that's how Washington works, unfortunately. I do think that we could see movement on individual things. That's if Democrats are willing to pass or push through smaller pieces that were included in their HEROES Act. But then also there are some things, like I know the Trump administration is really pursuing payroll tax cuts as part of the next wave of federal relief. That's something that wasn't included in the HEROES Act. So it depends on where they're willing to give, if they're willing to give at this point. But I just know from in our delegation, there are still, according to Senator Baldwin, for example, plenty of industries that aren't really giving the necessary attention that other industries are. Specifically, Senator Baldwin talked about dairy farms in Indiana or in Wisconsin that have not really felt much relief from this administration since President Trump took office. She always says over 2,000 plus small dairy farms has shuttered since he's taken office, and PPP loans really excluded the situation that they face. They don't necessarily need relief when it comes to payrolls. They need relief for other things. A lot of people aren't buying in bulk as they used to, so they have to start dumping their dairy products. So really, moving forward, it'd be interesting to see how these many different interests make a pitch at the next wave that goes, or if it goes through the Senate and ultimately makes it to the president's desk.
Yeah, back to Victoria now. I'm having to call on you because you can't really raise your hands. But Victoria, what Torian said here about, maybe breaking it into smaller pieces reminds me of how the Republicans, for the most part, said that the massive price tag on that HEROES Act was they warned that this would overload, put too much money in the system, and overload, have too much debt, and ramp up the budget deficits. I think we had a new budget deficit figure out recently that showed how much the budget deficit is zooming up. And after the Great Recession, the Fed started to sort of unwind some of that stuff, and then here they are, they're throwing a bunch of money back in the system. And I'm wondering, when you talk to the people at the Fed or Treasury, are they worried about too much debt, too much deficit spending right now?
So the short answer is no, but it's a little bit more complicated than that. So the basic thing to understand is that right now, the conditions for the U.S. government to borrow money are very, very good. So the Fed has set rates at very low levels, and there's also a lot of demand for government debt. So when you think about how the U.S. government borrows money, is it sells bonds, right? It sells treasury bonds. And so treasury bonds are a very safe asset. And when you have sort of uncertainty, then you have a lot of people wanting to hold that U.S. government debt because it's a safe investment. They know they're going to be able to get a reliable return on it. Also, inflation is extremely low. And then also you have the Fed buying a lot of these treasuries. So in addition to the demand for private lenders, people like you and me, or companies, or whomever, the Fed itself is also creating a lot of demand for U.S. government debt. So all of that to say, it's actually extremely, extremely cheap for the U.S. government to borrow money right now, which makes it a good time to run up the deficit. The question becomes, whether you're spending that money on things that you should be spending it on, right? Because, if you think about the unique situation that we're in, basically we're in a situation where the government has shut down a lot of the economy. And so a bunch of spending just suddenly evaporated. And so in that sense, you see even a lot of conservatives in Congress in March, talking about how the government needed to step in because otherwise there was just sort of this black hole in the middle of the economy. So, you hear people like, Fed Chair Powell or Treasury Secretary Mnuchin to a lesser extent, talking about how, this is the time for government intervention. When Torian has talked a lot about the House Democrats bill that was like $3 trillion. I think that some conservative economists who say, yes, we need to spend right now. We don't need to worry about the deficit right now. You can't worry about, the budget at the expense of the economy. They might quibble with some of the things in that bill and say, well, not all of these are really about addressing the coronavirus relief package. So, I think there's sort of a balance there, but the short of it is this is a good time to borrow, and this is a time when we probably need to borrow.
So now to Polo, that the Fed backing up the markets has helped the bond market and the stock market, and it kind of provides cover for a delay in policymaking in a way, because if you measure the economy by the stock market, looks pretty good. But you must see some or hear about some worrisome trends or data points out of the Fed. Polo?
I think people probably agree that's a fair assessment. Certainly the Fed's backstops have helped financial markets recover from or partly recover from what they saw in March. But I think Fed officials are pretty aware and pretty worried that this could have longer term consequences. They've brought up racial inequalities and how those could worsen because of the pandemic and are worsening. They're worried that some of these layoffs could start to be permanent. Some of these businesses start to shut down permanently, and that really severs any connections between employers and their employees, right? And kind of makes it hard because those laid off employees will have to find new jobs in a pretty bad economy. I think there is some concern from some folks that the Fed's response has touched quite a bit, right? Municipal bond markets, corporate bond markets. The PPP program has obviously reached a lot of businesses, but I think there's some concern among folks, particularly on the left, that would say that some of these things are still incomplete, right? And we could still see a second wave of the coronavirus, and maybe are seeing it in some places. I think some folks would like Congress to move a little bit quicker and not necessarily assume that the economic recovery is complete, right? Because the job numbers don't quite bear that out, and are expected to, unemployment's expected to stay pretty high for quite a long time.
Okay, here's some audience questions. This is for you, Torian. There's all this talk about an infrastructure bill. Does the congressional delegation, the Republicans and Democrats, can they agree on a big infrastructure bill to get people back to work?
At this point, it's not looking likely. Again, the pandemic is at the center of everyone's mind. So fighting for the HEROES Act is what Democrats will push heavily. Now, you'll hear them say, and this is for both sides of the aisle, we could walk and chew gum at the same time. It just seems unlikely that infrastructure will be at the forefront or even a legislative priority as we approach the end of the year during an election season when there's so much other work to be done.
Okay, this is, I'm going to throw this to Victoria. This is an audience question. Do you ever see any studies or commentary from the Federal Treasury on results of the tariffs and the effects they're having on the economy?
Yeah, so it's actually really interesting because covering the economy, for the couple of years before before all of this happened, the tariffs were sort of the thing that was the big question mark around the economy, and obviously here in the Midwest, it really added to farmer troubles, and manufacturing was in a recession for a while. I think this most recently they've sort of briefly come out of a contraction. But anyway, yeah, no, I mean, there's been a lot of work done within the Fed. The Fed has a lot of research, and not all of it is necessarily endorsed by, the principals, but they do a ton of great research, and a lot of it has really shown that the tariffs, slowed growth, made things a lot harder. So Treasury, I mean, Steven Mnuchin has been a big part of trade policy. So I would imagine the message from there is much more positive. But it's really interesting to think about, how much that's fallen by the wayside now, even though in some ways, President Trump is still pursuing more tariffs. And that's still a factor that's kind of weighing on the economy in the way that it was before, but now there's just sort of this anvil that's been dropped on the economy beyond the tariffs.
Right. Certainly, agricultural markets were in turmoil. Even before the pandemic and all that happened there. So the tariffs certainly had an influence on roiling all the markets, and China being still a huge customer for ag products from the U.S. Polo, can you shed any light on any research or stats in terms of the tariffs, ag products from the Fed viewpoint?
Yeah, I think Victoria mentioned there are some research papers, not necessarily endorsed by the top folks at the Fed, but just from economists. It did show that I think tariffs did create a good amount of uncertainty for business and probably slowed investment some. But I don't think there's been anything recently, but there's certainly quite a bit, and that was a major concern, several months ago. And obviously with tariffs potentially being on the table again could be of concern again.
Okay, so let's just, I'm going to go down the line here. We're closing it out, and I'm going to start with Torian and then work my way back to Victoria. What are you looking for? What sign or what event are you looking for that will change things up for the economy?
I think
maybe it may be for Torian, it may be a political event or an election event, but what are you looking for?
Well, as it relates to this pandemic, I will be watching what Mitch McConnell does. Whatever he signals will be a huge thing, because even though the president is saying he's quite clearly on board with another round of individual checks, if Mitch McConnell doesn't pull the trigger on that, and he usually aligns with the president, he usually follows what he says, then we won't have movement in July on the next round of aid. But after that, the conventions are coming up. How that would look, I talked to some delegates in Wisconsin who still don't know if they'll be allowed to attend Biden's acceptance speech on the last day of the event. The rest of the event is supposed to be virtual. So it'll be interesting to see how that moves forward and what the deal is with the RNC. I know they're facing some potential difficulty with having an in-person convention because they were quite steadfast in going forward with that. So it's a lot to look forward to, but 2020 has been quite the year to watch anyway. So.
Okay, thank you, Torian. Polo, what sort of data point or event are you looking for that'll change things for the better, I guess, for the economy?
Yeah, I guess the one thing I'd look at for more concerning signs is just any permanent effects, any permanent job losses that are turn into make the recovery even slower, right? And I think particularly for Wisconsin, I think Tom mentioned, there's a big recreational and tourism industry, right? And it seems that folks are traveling right now, but and maybe staying at kind of smaller hotels, but kind of the bigger hotels that kind of have conference space and such and host groups or the Democratic convention, right? Could see pressure. And then just kind of on the manufacturing side, because the state is such heavily concentrated manufacturing state. There's certainly some products like toilet paper manufacturers that certainly saw a lot of interest early on in the pandemic. But just broadly speaking, there's been just a lot of, or there will be expected to be a lot of sluggish demand in the years forward. And so you could see a repeat of kind of some of the trends we saw in 2015 when there was manufacturers were laying folks off, oil prices were low, there's just low demand globally and just sluggish growth globally. And so that is all stuff that just affects the manufacturing industry in the US, less orders, whatnot, and certainly could affect Wisconsin somewhat disproportionately and weigh on growth in Wisconsin for some time.
All right, Victoria, what sort of data point or event are you looking for that could change things for the better?
Yeah, well, so I completely agree with what Torian and Polo both said. So I guess I'll take the other one, which is the health outcome. I mean, it's so much of what's happening in the economy is driven by the path of the virus. We're seeing things like California starting to shut back down again. We're starting to see, Texas have, reimposing restrictions because of surges. So, I guess it really comes down to, a vaccine. And then in the meantime, preventative measures like mask wearing, things like that, as to whether that will help bring down the new infection rate, so that people can feel comfortable returning to normal economic activity, and the economy can sort of begin to heal itself. So that's what I'm paying attention to.
Well, we did our part. We met virtually, right? Okay, so I want to thank Victoria Guida from Politico, Torian Small from Spectrum News DC Bureau, and Polo Roca, a reporter with S&P Global Market Intelligence News Service based in DC. Thank you very much, all of you. Thank you to Thomas Wallstrom, a senior business economist with the Federal Reserve Bank of Chicago. We've recorded this and we'll be putting it on our YouTube channel later on, so you can watch it again or send it along to people. I want to thank our sponsors for the DC event series. I don't know when we'll next be in DC, but I hope to see you all soon in person. I want to thank Michael Best Strategies, WPS Health Solutions, Excel Energy, and Exact Sciences, and thank our partners UW-Madison and Wisconsin Alumni Association. So this is Jeff Mayers from WisPolitics.com signing off for today, and